Hello, everyone. This is Beard with Think Bank, your credit mentor, Mr. I Do Mortgages. And I want to give you guys 8 reasons why you should be refinancing your mortgages right now. Rates are at an all-time low, and you should be taking advantage of it. So, again, I want to give you these 8 reasons. So, let's jump right into it. All right. So, the first reason people are looking to refinance their home, especially during this COVID-19 coronavirus pandemic, is to lower their monthly payment, so they have a little bit more monthly cash flow to help them survive. So you can, if you have an interest rate in the 4 or 5s right now, it's definitely worth looking at or entertaining to see if you can lower your monthly payment. Okay. And if you can save $100, $200, $300 every month, I mean, that adds up. I mean, we're talking from 1,200 to potentially a little over 3 grand in savings for that year, just because you were able to lower your monthly payment. And just imagine what they could do for you, even right now, okay, during these times with the COVID-19 and everything that's going on. Some people are also, the second thing they're looking to do is cash out, do what you call a cash out refinance for home improvements. Take equity out of your home to redo the kitchen, redo the bathroom, redo the flooring, put new windows, paint, roofing, all those things. You want to do some upgrades to your home. You can pull equity out of your home to do it. Okay, and it's called a cash out refinance, or it's something you can do called a home equity line of credit. The next thing people are doing, the third thing, is debt consolidation. So if you have some credit card bills that have, the interest rates are in the teens or even 20s, it may be smart to look into potentially doing a debt consolidation of all those debts by using the equity in your home, because obviously those rates are going to be in the right now they're in the threes. So you're gonna be able to transfer a 15, 20, whatever percent interest rate that you have on these credit cards and that debt, and you can put it on a lower interest rate in around three, so you're not paying as much interest, so it doesn't take you as long to get out of debt. Okay, get out of that credit card debt. I see a lot of people doing that. Okay, whether it's your credit cards, whether it's other loans that you just want to consolidate, just so that you can have a lower monthly, just lower monthly expenses in general. I know people that just consolidate all their debts into their mortgage, so now they only got that one monthly mortgage payment, and now they can get rid of six, seven, $800,000 in just other debts that they were paying on a monthly basis. So it just frees up a lot of cash flow. Okay, the next thing you can do is, which is the fourth thing, is it basically helps you save interest just over the life of your loan. So say for example you're in the 4s or 5s, and then you basically reduce your interest rate into the 3s. Okay, just think about it. Let's say you had a $200,000 loan, and your interest rate was 4.5, and you dropped your interest rate down to 3.5%. Okay, that 1% could save you anywhere from fifty to $150,000 in interest over the life of the loan. And again, it depends on how large your loan is, but it can save you tons of interest that you don't have to pay back to the bank. Okay, you can put that in your pocket, so you can save that money instead of it going out. All right. Another reason people refinancing right now is to shorten the term of their loan. Okay, so they can pay off their home faster. All right, especially you start to approach retirement, things of that nature. You want to be able to not have a mortgage payment. Okay, so some people look to say, let's change this to a 20-year term from a 20. I maybe have 28 years left. Let me go to a 20-year term. Or let me go to a 15. Let me go to a 10. Now, obviously, when you shorten that term, your payment is going to increase. So you're going to see kind of a payment shock. But if you have the means to do that, you can pay off your home a lot faster. You can save in interest, and you can start creating equity faster in your home because you're shortening the term, and now you have more money going towards the principal balance compared to interest. The sixth reason people look to refinance is they may be going through a divorce. And you need to take your ex-spouse off the loan, or they need to get a portion of the equity out of the home, with whatever the settlement was. That's another way to, again, to remove your ex-spouse off the loan. You have to refinance to do that. Okay. The seventh step, the seventh reason why people look to refinance is to remove the PMI, private mortgage insurance. And basically what private mortgage insurance is, it basically protects the bank in case you default. So if you did not put 20% equity down on your home when you bought it, you're going to have mortgage insurance. Okay, whether it's a FHA loan or a conventional loan, you're going to have that mortgage insurance. And two ways to get rid of it is, in some cases, once you get 20% equity in your home, and you've been in your home a certain amount of years, that the mortgage insurance automatically comes off. In some cases, it has to be at you have to have at least 22% equity. Now, in other words, you would have to refinance it to get it off your to get that PMI off your payments. So again, two ways: either it automatically will drop off once you get 20% equity, or once you do get 20% equity, you're going to have to refinance your mortgage to remove the mortgage insurance. Okay, and basically it's a monthly insurance that's added to your payment that's outside of your principal, interest payment, and taxes and insurance. Okay. The next and final reason people refinance is some people are in an adjustable rate mortgage now and they want to go to a fixed rate. So you're in an adjustable rate and you want to go to a fixed rate. And a lot of people get into ARMs, which is not a bad product. It's actually a great product for some, depending on your situation. Some people may be and they know they're only going to be in this house 1, 2, 3 years. So they may get a 3-year ARM or a 5-year ARM where it's fixed for the first 3 to 5 years, and then it can adjust after that. So they know I'm not going to be in this house that long anyway. So why not get into this ARM, because typically the rates are lower, and then I can sell it or whatever the case may be before the adjustment period starts. Now, but at this time, because rates are so low, I recommend a lot of just about all my clients to go to a fixed rate, just because it's comparable to an ARM rate anyway, or sometimes in some cases even better than an ARM rate. So no need to go into an ARM rate where you can stay in a fixed rate and nothing's going to. This is something that you're considering doing as far as a refinance. I'll be glad to help you. I'm a senior mortgage loan officer. I've helped over 1,500 people either refinance or purchase a home. I've been doing this for over a decade. So I'll be glad to help you. Only thing you would have to do, it should be a link somewhere below on my YouTube channel that you can click on, schedule a call with me, and we can kind of go through your goals to see if this is something that even makes sense for you. And if it doesn't make sense for you, I'll be the first to tell you. I would stay put. No need to do anything right now. Or if it is something that will benefit you, I'll definitely break down the benefits and why it's a benefit for you to do it at this moment. So again, appreciate you checking in and watching this video. Hopefully it was helpful for you.